Hi, welcome to this session on financial statements. We're considering here our Level 4 financial statements paper, which is one of the compulsory units to complete your Level 4. My name's Crystal Haygreen, and I am an AAT course manager, assessor and tutor here at First Intuition. Now, if you've just started Level 4 and you're considering perhaps which option units you should take, or you need any help and advice in relation to your AAT studies, then please do get in contact with me. My email address here is crystalhaygreen@fi.co.uk. So please get in touch if you need some help or advice. So we're going to be having a look at our financial statements, some areas that are covered by our framework. So the Conceptual Framework. Conceptual Framework has been produced by the International Accounting Standards Board. So this is the governing body that comes up with our accounting standards, our rules, regulations and guidelines that we follow when we're preparing financial statements for a company. Now, the framework isn't actually one of our international accounting standards. Our framework really lays out the guiding underlying principles that we follow when we're preparing our financial statements. The framework provides us with guidelines to help us interpret our accounting standards, and also the IASB use the framework when they're looking at developing new standards or amending current ones. So the framework isn't prescriptive, but it does lay out some principles that we should follow when we're preparing our financial statements. There's a number of areas covered by the framework. Some we're going to have a look at in more detail, but the framework does lay out the objectives of the financial statements. So it identifies, well, what's our purpose? Why are these financial statements being prepared? So the objectives being that provision of information to our creditors and people who have a financial interest in the business. So providing information to our stakeholders. And we're providing information about the company's position, performance and changes in their position that have occurred. The framework also identifies who the users are of the financial statements. So we have a range of stakeholders and a range of users of financial statements that will be using the financial statements for a variety of reasons. We might have our shareholders or potential shareholders deciding whether to invest or sell their investment. We might have lenders who are deciding whether to lend money or not. Customers, suppliers who are making the decision about whether to trade with us. The conceptual framework also lays out these underlying assumptions. So this is where we consider things like our accruals concept and going concern. Identifies our qualitative characteristics. So those characteristics that we must have, and we're going to look at those in a bit more detail shortly. The elements of the financial statements, the elements being those things that are included in our financial statements. So we have our assets, liabilities and equity that will all appear in our statement of financial position, and our income and expenses are those elements that will be in our statement of comprehensive income. Our framework also identifies our recognition criteria, and recognition, this identifies, well, those elements. When do we include them in our financial statements? When are they recognised? When do we recognise that income, expense, asset or liability? At what value do we measure them? So our framework also provides guidelines on how we value those elements. So our elements are what we include, recognition, when we include it, and measurement at what value. So this is all laid out in our framework. Now we're going to look at the definitions of our elements. This is very important that you learn these definitions for your assessment. They could be a short form question, or you could need to explain these elements, define and explain them as part of a longer form question, so one of our manually marked questions in the assessment. Perhaps you're providing an email or a memo to someone else in the organisation to explain what these elements are. We're also going to have a look at our recognition criteria. Again, short form or long form question in the assessment, and the qualitative characteristics. A short form question perhaps identifying which are qualitative characteristics, or maybe a longer form question where you need to explain what these qualitative characteristics are. So the elements in our financial statements, we have assets to start with. An asset is a resource controlled by an entity, so controlled, not just owned. A resource controlled as a result of a past event, so it must be something that's happened that's enabled this company to have this asset, and from which future economic benefit is expected to flow to the entity. So the business is expecting to receive some benefit from this asset, either in the form of it being physical cash, it may turn into cash if it's sold, or it may be something that can be used to generate economic benefit. So 3 important parts there: a resource controlled as a result of a past event from which future economic benefit will flow. So a liability. A liability is a present obligation. So the business is obliged to have an outflow of economic benefits in the future. It must be a present obligation, so an obligating event has taken place. So a present obligation as a result of a past event from which future economic benefit is expected to flow out of the entity. So a liability, something that is owed as a result of a past event. So an event has occurred, an obligating event, and it's going to result in a transfer of benefit from the organisation. So whether it's going to be settled in cash or settled in some other way. 3 important parts there: present obligation as a result of a past event, and there's going to be that outflow of economic benefits. Equity. Equity is the owner's residual income. So our equity section in our statement of financial position consists of our share capital and all reserves. So it's the residual income, the assets valued over liabilities. So assets less liabilities will give us our equity. So that is in effect our net assets. That's our assets minus our liabilities. And that is our equity section, consisting of our share capital and all reserves. So 2 more elements are income and expenses. So income and expenses, we have a statement of financial position approach to these definitions. Our income will be increases in economic benefits. So increases in economic benefits, and this results in an enhancement of assets or a decrease in liabilities. So with income, the value of our income, it will result in our assets increasing or our liabilities decreasing. So perhaps we have sales income. We could have sales income that's a sale made on credit. It enhances our asset of our trade receivable. That money is owed to us. Maybe it's a cash sale that's made, so we have an immediate inflow of cash. We currently have an overdraft being a liability, being overdrawn at our bank account. We receive this cash sale, cash comes in, goes into our bank, it will decrease our overdraft. It will decrease our liability. So income will result in an increase in asset or a decrease in liability. It will be an inflow to the organisation. An expense will be a decrease in our economic benefits. It's in the form of an outflow, so cash is paid out, or an asset reduces or liabilities increase. So we incur an expense for rent. We receive our bill for our rent expense goes up, and we owe this money, so our trade payables will increase. That will be an increase in our liabilities. Or we pay for it cash. Cash comes out of our bank account and it reduces the balance on our bank account, the asset goes down. So income, expense, equity, liabilities and assets are 5 important definitions that you need to learn. Now, the recognition of these elements in our financial statements. For our recognition, we have criteria that has to be met before these elements, asset, expense, income, liability and equity, can be included in our financial statements. So, the recognition criteria. First of all, our element must meet the definition of the element. So we've just seen those. An asset has to be that resource controlled, past event, and future economic benefit is expected to flow. It also has to be probable, so kind of more than 50% chance that that future economic benefit is going to flow. So for each one of our elements, we have to consider, is it probable? And finally, for us to be able to include the element in our financial statements, we need to be able to reliably measure its value. That asset, expense, income, liability or equity needs to be included in our financial statements at a value. So, 3 criteria for the recognition of our elements into our financial statements. Now finally, we're looking at our qualitative characteristics. These are laid out by our framework that's provided by the IASB. Qualitative characteristics, these are the things that our financial statements should contain, they should be. So these are the characteristics that they should possess when they're prepared. So we have 2 main qualitative characteristics, and these are relevance and faithful representation. Our financial statements must include relevant information and they must present fairly the economic transactions of the entity. In addition to these 2 characteristics, we do have some enhancing characteristics. So first of all, relevance. Relevance included in our financial statements should be all of those things that will influence and make a difference to the decision made by the user of those financial statements. So an item or a piece of information is relevant if it would enable the user of the financial statements to be able to predict what's going to happen with the business in the future. Information is relevant if it's confirming things that have happened in the past for the organisation. if we have financial information that is material, it will be relevant. So materiality, what makes an item material? Well, an item can be material just by its nature. Because of the type of transaction it is, it makes it important and it means that users need to know about it. So transactions with owners, well, they're going to be material just by their nature because of the type of transaction, the risk that could be associated with those transactions. Other items, we need to consider their significance. If we had an organisation and they had turnover of, say, £100,000, and there was an item missed out, an invoice that had been missed for £1,000, probably the fact that that item has been missed for £1,000, it's not really going to change decisions that are made by the users because it's not there. But if our company had turnover of £10,000, if that invoice for £1,000 was missed, that has much bigger impact. It's much more significant and that item would be material. So all material items are included in our financial statements. Faithful representation. This makes sure that what we're reporting in our financial statements really does represent this business's position and performance for the period. So if we're preparing 12 months worth of financial statements, 12 months worth of transactions should be completed in there and should be included. If we have 5 branches to our business, the transactions and performance for all 5 should be included in our financial statements. So they must be complete. They should be unbiased. So they have to be prepared on a neutral basis, clearly reporting the transactions that have taken place. Free from material misstatement and error. So we always look at this free from error within that boundary of materiality. And they should report substance over form. Now we have many standards that help us to report this, but we should ensure that transactions are included based on their economic reality, not necessarily just their legal form. So when an asset is acquired through a hire purchase agreement, a finance lease, that asset is included as if it is owned, because we would have control of that asset. So rather than just reporting it as an expense being paid out over a period of time, we consider the economic reality of a transaction. So we also have these 4 enhancing qualitative characteristics. Comparability. We make sure that our financial statements are comparable year on year. So we can't just change the way that we present things. We've got set formats, so comparable between different entities. Verifiability. Well, we ensure that a transaction is included based on its true reality, that individuals would come to the same decision as to the nature of that transaction. Timeliness. Financial information is available to the users in time, in enough time for them to be able to make economic decisions. If financial statements weren't received for 3 years, then they're going to be very out of date and therefore wouldn't be useful to the users. Understandability. Sometimes this conflicts with some of the others, but we should ensure that our financial statements are understandable. We have the same presentation year on year, and in addition to our main statements, we have a number of notes, and the notes will provide more detailed information to ensure that they're understandable to the users. So there's a number of things there with your framework, our conceptual framework laid out by the IASB. Hopefully that will help you to answer some of the discursive questions that you could see appearing in your assessments. I'm Crystal, and my email address is crystalhaygreen@fi.co.uk if you've got any questions on the areas I've just covered there, or in need of any advice on your Level 4 AAT studies.